I showed you in a video how to download earnings call transcripts and presentations from the Investor Relations website. These are great sources for historical information on the company's performance. However, investors are concerned about the future financial performance of a company. In valuing a stock, it's the future earnings and cash flows that are of primary importance. We often look to the historical cash flows and earnings in order to get a guide for what they can do in the future, but investors pay for stocks right now in order to get those future earnings and future performance. So how can you get information about what the company is going to do in the future? Some companies offer voluntary information called management guidance. This is the voluntary disclosure of the expectations for future financial performance. And as an example, a company may on an earnings call with analysts state that the management expects revenue growth of 3 to 5% in the next fiscal year. How can you get this information for the company that you're trying to value, the company you're trying to analyze? This can be tough. I mean, one thing that you can do is go to the Investor Relations website and listen in on the earnings call and try and find where the management actually said something about the future performance. It may be buried within the audio file of what they said on the earnings call. It can be really tough to find, but there are other ways. So let me talk about how you can use Capital IQ to get more information. And so I pulled up the Capital IQ website, and I'll start with Dunkin' Brands. I'll just type in the ticker symbol, and I'm going to scroll down under estimates here. You see CIQ estimates and also guidance. I want to click on guidance, and what this does, and I'm going to blow it up a little bit because it's a massive amount of text, right? I mean, this is very intimidating in some sense. What it tells you is that on October 25th of 2018, Dunkin' actually raised their corporate guidance. And here's the headline associated with it. And all it really tells you in the headline is that they provided earnings guidance for the fiscal year ending December 29th, 2018. So actually, this is not that much guidance according to the headline, because here on October 25th, they're saying that they're providing some guidance for that fiscal year that ends just a couple of months away. But then again, investors would face a delay in actually getting that earnings information because companies don't release right after the end of the fiscal year. It can take a month or so to actually get the numbers out. Usually at the bottom, this is the text, right? And this is what Capital IQ calls a situation, but they've come up with a summary of what was said on the earnings call. Usually at the end, they talk about the expectations. And you can see here, the company is reiterating and updating certain 2018 performance targets. That's completely useless information to me. But here it says the company expects to have approximately 1% comparable store growth for Dunkin' US and single-digit comparable sales growth for Baskin-Robbins. Now, Baskin-Robbins isn't that important to the overall corporate performance. And they're expecting low to mid single-digit revenue growth. They talk about the operating income growth, the tax rate, and they talk about the capital expenditure. So remember, if you're trying to compute if you're trying to compute free cash flow, what you want to do is take that net income, add back the non-cash charges, and then subtract out the expenditures that are expected for fixed capital, for working capital. And here the company is actually telling us what the CapEx is going to be within a range of $5 million, which is pretty good. But understand, this is entirely in their control. They have that cash on the balance sheet. They come up with a capital budget every year, and it's up to them to actually make the decision. So they're going to be more informative about these things that are under their control. And they're actually writing the checks for these capital expenditures. It's different when they're talking about comparable sales growth because they're depending on customers coming in and actually buying products. So it's not entirely under their control to experience store sales growth. They can do things to influence it, but they can't control it like, or at least they don't have the same degree of control that they do over capital expenditures. So here at the bottom, you can see it summarizes this. And you can see for fiscal year 2018, the management was guiding between $2.8 and $2.82 in earnings per share. You can click on this and see the history associated with it, when they actually announced this. For example, they've changed the guidance quite a bit. In February 8th, they said it was going to be in a range of $2.40 to $2.45. They upped that in April. They decreased it in July 26th. Then they upped it on October 28th. So you can actually see the history. This is really valuable of what they were actually doing. So they've changed it quite a bit, but over time they've actually increased it, is the general trend associated with it. For the fiscal year 2020, they're not saying much. I mean, they're basically saying the same store sales growth is going to be between 1% and 3%, which is barely beating inflation. And actually, it's not beating inflation. It's probably going to be just matching inflation if you consider inflation about 2 or 3%. So this gives a good example of the kind of information that you can get. But let's take a look at another one. And what I'd like to do is talk about, let's see, I'm going to pull up a company called Sally Beauty, and the ticker symbol is SBH. And I've already jumped to the guidance section of this. They last talked on November 8th, and what can you see about what they said? Now, this one is much better in my opinion. Not only are they talking about what they're going to do in terms of CapEx, but they're going to give you guidance for the cash flow from operations of $340 million, and my favorite, they're going to tell you that they expect free cash flow of $220 million. Now, they're not telling you what free cash flow measure. Is it free cash flow of the firm? Is it free cash flow to just equity holders? You have to make sure that you understand what term they're actually using. But this is great, and this is for fiscal year 2019. You can see the history associated with this if you want. And this is the first thing they've said about free cash flow. And apparently it does represent a measure of free cash flow after the working capital changes. So they're giving you a little bit of an indication of what the company is doing and actually computing this. So you need to go to your whatever company you're analyzing, pull them up, and you never know what you're going to find in terms of guidance. I mean, they may be offering a lot, they may be offering a very little, but Capital IQ does a good job of summarizing it. They've got this big block of text. I know it's hard to believe that's a summary, but I think in some sense it actually is. And then they're putting on a timeline too, based on the fiscal years. So I hope that you find that informative in figuring out what the future performance of the company is going to be.